Welcome to the Deep Dive. Today we're tackling a big one, the 2023 shareholder letter from Fairfax Financial Holdings Limited. It's quite the read.
It really is. And it details, well, an absolutely phenomenal year for them.
Right, so our mission today is pretty clear. We need to get under the hood of this compounding machine that Prem Watsa runs. It's fascinating how they manage both insurance and investments.
That's the core of it, yeah. Those two massive engines working together.
And 2023 seems like the year they were both just firing perfectly.
Firing perfectly is a good way to put it. I mean, the letter pulls no punches, calls it, quote, by far the best year in our history.
Okay, so what are the headline numbers that scream best year ever?
Well, you've got a record underwriting profit, $1.5 billion, and then record net earnings, $4.4 billion. That works out to, what, $173 per share? Just massive.
Wow. But this isn't just a flash in the pan, right? There's a long track record.
Oh, absolutely not. This is built on decades of discipline. Since 1985, the book value per share, it's compounded at 18.9% annually.
18.9%?
Yeah.
Over almost 40 years.
That's
well, that's why we need to look closer.
Yeah.
Exactly. And the scale today is just huge. FFH is now one of the biggest property and casualty insurers globally. We're talking $32 billion in gross written premium, especially after factoring in that Gulf Insurance Group deal.
TIG, yeah. That was a significant addition late in the year.
But what really caught my eye is the growth since 2017, after their big acquisitions like Allied World and Brit. Gross premiums are up, what, 109% to $28.9 billion.
Yeah, right. More than doubled.
And the letter makes this incredible point. The assets they bought for about $5.8 billion, which brought in $5.1 billion in premium initially. Those same assets helped drive another $15.1 billion in purely organic premium growth over 6 years. Essentially, like they say, at no cost.
That seems almost unbelievable.
It's incredibly efficient capital deployment. Very rare to see that kind of organic leverage from acquisitions.
Yeah.
And that firepower feeds directly into their investment.
Right. So the investment portfolio is up 65% since 2017 to nearly $65 billion. $64.8 billion. Yeah. And the insurance money they get to invest, that's up 53% to $35.1 billion.
Okay, let's just quickly define float again for everyone. It's basically the money insurers hold between collecting premiums and paying claims, right? Money they can invest for themselves.
Exactly. It's the upfront cash. And Fairfax's whole goal is to grow that float ideally at no cost, meaning their insurance operations break even or make a profit.
And in 2023, well, they smashed that goal.
They didn't just get it at no cost. Because the underwriting profit was so high, the cost of float was actually a benefit of 4.9%.
So they were getting paid almost 5% to hold billions of dollars they could then invest.
Precisely. That's the magic of profitable underwriting combined with investment scale. It's a powerful, powerful advantage.
And they've been buying back shares too.
Aggressively. Shares outstanding are down 17% since 2017. So when you look at float per share, it's exploded up 85% to $1,525 per share. That buyback really juices the per share numbers.
Okay, so let's look at that insurance engine room. $1.5 billion in underwriting profit, a 93% combined ratio. We should probably explain combined ratio quickly, too.
Yeah, good idea. So the CR combined ratio, it's just your claims costs plus your operating expenses divided by the premiums you earned. Simple as that.
And under 100% means you made money just from writing insurance before any investment income.
Exactly. So 93% means for every dollar of premium they took in, they paid out 93 cents in claims and expenses, leaving 7 cents of pure underwriting profit.
And that 93% is despite $900 million in catastrophe losses. That feels incredibly strong.
It is. Those cats added 4 points to the CR. So without them, it would have been even lower, like 89%, which is, well, best-in-class territory. Industry average is often around 100% or even higher.
Who are the standouts within Fairfax?
Well, Allied World had a fantastic year, an 89% CR on $6.8 billion in premium. Odyssey Group, they hit a 93% CR on $6.3 billion premium, and that's their 12th straight year of underwriting profit. Consistency.
12 years is impressive. Any turnarounds?
Brit. Definitely Brit. They had an excellent 92% CR. The letter notes it almost wiped out all their prior cumulative losses in just 1 year. That's huge.
So how do they achieve this across so many different companies? They run, what, 26 decentralized units?
26, yeah, and over 225 profit centers. It flies in the face of the usual consolidate everything, cut costs model you see elsewhere.
Doesn't that risk inconsistency? How do they maintain discipline?
It comes down to culture. and empowerment with accountability. They trust their managers. They want them to be entrepreneurial. But underwriting discipline is absolutely paramount.
Is there an example of that?
Yeah, the letter mentions Odyssey Group's premium actually shrank by 3% last year. Why? Because they walked away from a big account when they couldn't get the price they wanted.
Ah, so profit over growth.
Always. Growth is fine, but not at the expense of underwriting profit. That seems to be the mantra.
And they seem to emphasize the people side, too, adding the golden rule to their principles.
Yeah, I thought that was notable too. Formally stating, treat others as you would want to be treated. It says a lot. And they also highlighted their Ukrainian operations, which, incredibly, have continued running successfully despite the invasion. That takes immense trust in your local team. Okay, shifting gears to the other engine, investments. The total return in 2023 was 8.4%. Pretty solid.
Slightly above their long-term average, right, which is about 7.7% over 38 years.
Exactly. But the really interesting part for 2023 was the interest income.
Ah, yeah, that nearly doubled to $1.9 billion. How did that happen? Was it just luck with rising rates?
Not luck, preparation. This is key. Back when rates were basically zero, 2019 to 2021, they actively resisted reaching for yield like so many others did.
So they didn't buy lots of long-term bonds.
No, quite the opposite. They kept over half their fixed income portfolio in cash or very short-term treasuries. They were positioned defensively.
When rates shot up.
Bingo. They were sitting on cash, ready to deploy at much higher yields. Now the yield on their fixed income book is up to 4.6% from just 2.2% in 2022. It's a massive swing, driven by patience.
That patience let them be opportunistic, too, I guess, like with those real estate loans.
Exactly. They partnered with Kennedy Wilson to buy $2 billion worth of U.S. first mortgage construction loans. These are pretty conservative. Average loan to value is only 51%, but they yield around 10%.
Nice return for first lien debt.
Yeah, and overall they have about $4.6 billion in these kinds of first mortgages, mostly on multifamily properties, which are generally seen as resilient.
Looking beyond North America, India seems like a huge focus area.
It really is. India's projected to be the third largest economy soon, maybe by 2027.
Yeah.
And Fairfax has some potentially huge winners there.
Like Digit, the insurance tech company.
Yeah, Digit's performance has been incredible. 61.9% compounded annual return since they invested in 2017. And it looks like it might be heading for an IPO.
And Bangalore Airport, they call that a crown jewel.
BIL, yes. Valued at $1.6 billion on their books now. It's a core long-term infrastructure play for them in India.
Okay, so lots of success stories on the investment side, but they also talk very openly about a major failure, don't they?
Oh, yes. You can't discuss this letter without mentioning the major mea culpa. It's quite extraordinary, actually.
This is about the BlackBerry investment.
The BlackBerry investment, a huge $1.375 billion bet made back in early 2014.
And how's that looking now?
Not good. They bought at $17.16 per share. At the end of 2023, it was valued on their books at $3.54 per share.
Ouch.
Big ouch. And Prem Watsa calls it a horrendous investment in the letter. He even goes on to calculate the opportunity cost, what that money would have been worth if they'd just put it in the FAANG stocks instead.
Wow, that's unusual transparency.
Extremely unusual. It's a very stark admission of a massive error from a legendary investor. Real humility there.
That kind of hit must feel even worse when you layer on accounting changes. We probably should touch on IFRS 17. The letter calls it the most significant accounting change ever for them.
It is, yeah. It fundamentally changes how insurance liabilities, the money they owe policyholders in the future, are valued on the balance sheet.
So for us non-accountants, what's the gist? What does it actually do?
Okay, simplified. Two main things. First, it forces them to discount those future liabilities using current government bond yields. Basically, a dollar owed far in the future is worth less today.
Right, time value of money.
Exactly. And second, they have to establish a risk adjustment for uncertainty. But the discounting part is key for volatility.
How so? How does discounting affect volatility?
Well, here's the interesting bit. IFRS 17 creates a kind of accounting, well, a cushion, because it requires them to mark their bond portfolio to market value and mark their net liabilities to fair value using those discount rates.
So the asset side and the liability side move together more.
In a way, yes, specifically in response to interest rate changes. Think about it. When interest rates go up, the market value of their existing bonds goes down. That's a loss on the asset side.
Okay, makes sense.
But when interest rates go up, the discount rate used for their liabilities also goes up, which means the present value of those future payouts looks smaller. That creates an accounting gain on the liability side.
So rising rates cause a loss on bonds, but a gain on liabilities, and they can offset each other.
Precisely. It acts like a hedge in the accounting statements. In 2022, for instance, when rates soared, they had about $1.1 billion in bond losses.
Right.
But they had a $1.9 billion gain from the effect of discounting those liabilities at higher rates. So the gain more than offset the bond loss in their reported earnings. It smooths things out.
That's actually quite clever from an accounting perspective.
It is. Though it's important to note, Watsa emphasizes in the letter that he manages the business based on the undiscounted underwriting results. He cares about the real profit from insurance, not the accounting boost from rates. The IFRS 17 effect is just a buffer against reported volatility. #outrip.
Okay, this has been a really fascinating deep dive. So recapping the big picture for you listening, 2023 was just a standout year. You had the hard insurance market boosting underwriting profits to record levels,
Right, those low combined ratios generating loads of cash.
combined with really disciplined investment management. That patience they showed when rates were low really paid off, leading to that surge in interest income.
The two engines working in perfect sync.
And looking ahead, they seem pretty confident,
Ah.
talking about sustaining operating income around $4 billion for the next few years.
Yeah, that's the projection. And the long-term goal remains compounding book value per share by 15% a year going forward. Still ambitious.
So what's the final thought we should leave everyone with?
I think it's that contrast we talked about. You have this incredible long-term compounding record, nearly 19% a year on book value, 18.2% on the stock price since the beginning. Just stellar.
Yeah.
But within that success story is this massive, admitted $1.375 billion mistake with BlackBerry. A horrendous error by their own admission.
So what's the lesson there?
I think it speaks volumes about investment temperament. Even the best, most disciplined long-term investors make huge, painful mistakes. The critical thing is having a structure, a philosophy maybe, that allows the overall compounding machine to keep running despite those inevitable setbacks.
Resilience built into the model itself.
Exactly. And maybe one last thing, that skepticism they express about today's high-flying markets, comparing it to the nifty 50 era back in Ben Grimm's day. They quote Graham saying about today's valuations, "Perhaps trees grow to the sky after all, but call me a skeptic."
A classic value investing perspective, standing apart from the crowd.
It really is. So maybe the question for you to ponder is, in a world chasing rapid growth, what does that kind of deep-seated skepticism and discipline really mean for long-term value creation? We'll leave you with that.